This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
The pivot point here where I think it's going to bounce, if you notice, look on the top left up here, see where it says spiders, look right above there at the date. Watch, keep your eye on that as I pinpoint the pivot point right there. That bounce could very well happen on October 29th, which is next week. So if you look at this forecast that I've made, this whole timeline here, this could take about 2 weeks for this all to pan out. You see? So next week or this week, we could see the downturn into next week. Then we could see a little bit of a rally, and then we'll have to, again, read the signals to see what it looks like. Now, look down at the bottom. You see here? See this stochastics? Which way is that headed? It's heading lower. So the K line, the blue line, the percent K, is telling us that today the momentum is now accelerating into the downward move. So that stochastic is almost ready to cross the red line there, which could actually trigger some more selling. So I point that out to you so you can really look at the mechanics in the market and understand, what's driving the market. Is it an oscillating indicator? Is it news? Is it political tension? Is it the VIX? Well, it's a combination of all those things. There isn't one indicator or one signal that's going to be the be-all, end-all of indicators. You have to more or less put the evidence all together. You weigh the evidence, and then you say, okay, what I've just read here, again, minus my opinion, right? Because you don't want to put your opinion in there. Looking at the evidence, which way is this leaning towards? Is it leaning more towards the buy side or the sell side? That's how we interpret the charts. We have to take all the information collectively and analyze it on more or less a scale. Is there more weight to the buy side or the sell side? And right now, again, the momentum and all the evidence is still showing pressure to the downside. Now, with that said, if the spiders starts getting down here to this support level, like I said, we could, what's going to happen with this divergence here? You can see that the price has already dropped quite a bit below this 20-period moving average. And whenever this happens like this, it's called the rubber band effect. The regular Market Guy followers know what that means. Again, if you're a new person, go to the Market Guy's website and go to the video library, and it talks about the rubber band effect. When or if this price starts dropping again, imagine a rubber band with one end being connected to the price, the other to the moving average. If it gets down here, then it will most likely start to snap back. Now, when I'm doing the weekly market report, I don't have time to explain all that, why I put, okay, a downward leg and then a bounce. Well, in my mind, I'm thinking, well, if it does go down, that rubber band's going to be stretched again, so we'll most likely see a bounce. And that's pretty much how it works. Now, let's look at the Qs, because the NASDAQ market here is showing pretty much the same signals as what we just saw in the spiders, okay? And so if you're looking at the Qs, and all of a sudden you're saying, well, my portfolio is loaded with tech stocks, then you're probably going to put more weight into this particular ETF than you would maybe the Dow, because the Dow Jones Industrial Average is more or less measuring 30 stocks that are driving the U.S. economy. But you got stocks like Apple, Microsoft, you get some of the other tech stocks that are out there, NVIDIA, and they are really, they're going to be more or less having that domino effect by looking at the NASDAQ. Now, again, just like the spiders, the NASDAQ oscillator down here, the stochastic is starting to move lower, okay? So we'll have to see how that plays out. The NASDAQ will most likely bounce before the spiders. And you might say, well, how do you know that? Well, I don't know that for sure. But you look at the timeline here, you see, remember on the spiders, my pivot point was on the 30th. My pivot point here is right around the 25th. So I think that the NASDAQ could come down a little bit, and then we'll start to see the bounce a little bit sooner. I believe we'll see the bounce sooner on the Qs than we will on the S&P. There's a lot more traders. The short-term traders, the swing traders, tend to trade more NASDAQ stocks mainly because of the market cap's a little bit cheaper. You can buy more shares as a whole, in general, I'm saying, in NASDAQ stocks. So you have a lot of people that are doing that. Interestingly enough, I'm just going to look at the Russell 2000. I'm going to hop to one other stock here. Let me see, RUT. All right. This is the Russell 2000. A lot of times will lead the other markets because this is a more broad-based index. This measures 2,000 stocks. And again, you'll see my pivot point here is, again, very much like the NASDAQ, where the pivot point, I think, will start hitting support right around the 25th of this month, which is only in a few days. All right, well, here we are on the 22nd recording this. And you'll see, again, the stochastic is a little bit further advanced to the downside on the Russell 2000 than in the other markets. Remember, this is most likely going to lead the other markets. So although the Russell 2000 is not a leading indicator, the VIX is, the Russell 2000 does have, it'll often trade out of sync with the other markets. So keep an eye on the Russell. And the reason that is because the Russell 2000 having such a wide scope of stocks, the institutions will start moving their money long before the private investors. So you have a lot of institutional activity that is more or less being tracked within the Russell 2000. So I think that you could see that the candle here on the Russell 2000 is a small-bodied candle. Now, the support level where I said we would bounce, we actually might even hit that tomorrow on the Russell. It might, the low for tomorrow might actually touch that, and it could maybe even start to bounce a little bit early. And the reason I say that is because the stochastic is already below 20 here. Let me just hop back to the spiders. Watch the stochastic on the spiders. Where is it reading? It's still at 29.10. You see? So the spiders is not yet oversold. If the spiders gets below 20, that would be oversold. The Russell 2000 is already in the oversold category. So although it could go a little bit lower, if you look at the history of the Russell 2000, if you look back, you'll see that almost every single time, well, not almost, every single time it got below 20, you can see that it rallied shortly after that. You see, so here it dropped, and right after that it rallied. Here in late March, it dropped below 20, and it rallied after that. Here in late June, it dropped and started to head back up, and it rallied with a big rally here. Here again, look, so you get 100%, with the exception, I would say, maybe, well, here it rallied a little bit. Doesn't look like much, but it rallied from 1700 to 1720, 1730, right in that area. I would say out of all the times the Russell 2000 was oversold, this area right here, mid-September and into October right here, were the only times it did not rally after it started pivoting up from that oversold condition, right? There's good reason for that, because September and October generally are the worst months of the year. And if you go back and look at any long-term chart, you'll see September/October are the times where we usually get the biggest sell-offs or market corrections. Now, what happens after that? Well, after the November elections, And right around the Thanksgiving holiday celebration, we start to see a very interesting thing happen, and we call that the Santa Claus rally. And I'm going to take a little time talking about this because the Santa Claus rally is usually what we see at the end of the year, and a lot of that as well is driven by the institutional traders. It's more or less window dressing, right? Let's say Jerry is an institutional trader. All right, Jerry's one of our newest followers here, and welcome, Jerry. Jerry lives in South Florida. I met him in Chicago. Let's say Jerry is an institutional trader, and let's say Jerry he knows the cycles, and he's going to buy in October. He's going to start buying some stocks in his portfolio. Well, come the end of the fourth quarter, Jerry wants to get paid his big fat bonus for all the great work he's doing for the institution he's trading for, right? So what happens is a lot of these institutions save a lot of their buying power, and they tend to rally the markets up, not just because it's a cycle and a repeating pattern, but when the markets rally up and it's time for Jerry to be paid his bonus, he's going to get paid the bonus on the stocks that he has made profits from. So if his account is making money on the last trading day of the year in the end of the fourth quarter, Jerry's going to get a bigger, fatter bonus. You see? So there is a tendency for the institutional traders to watch out for their best interest, right? For their own interests. If you want to call that manipulation, I don't care. Call it manipulation. I think it is. Window dressing is more or less pushing the prices around to best fit your own positions. And I used to see it on the trading floor all the time, especially towards the close of the market. When if there were traders that had long positions in a particular option, they would spend the last minute or 30 seconds. They would spend the last 30 seconds to try to get the highest trade possible printed on the ticker, so that they could mark their position at the most profitable time of the price range. You see, so that's how it happens. It's for real. It exists. The media doesn't talk about it because they don't want you to think that the markets are being manipulated, but they are all the time. Every day I see manipulation. You just have to know that it's happening, and that way you can expect it and even profit from it. Right. And this Santa Claus rally is a regular cycle. And after the Santa Claus rally takes place, I'll then talk about the January effect rally, which is another big cycle that we see over and over and over again. All right. There's one stock I want to mention, and that's CGC. Don't take this as a buy or sell recommendation. It turned out to be very interesting because the cannabis stocks rallied furiously last week, because in Canada, they legalized recreational marijuana. Now, what happened right after that? Boom. The cannabis stocks had the worst sell-off in the last recent trading days. And the reason for that is, and it goes back to the old saying, buy the rumor, sell the news. Did you ever hear that? Buy the rumor, sell the news. Well, back here, all the rage was, hey, Canada's going to legalize marijuana. Boom, boom, boom. So look at all this. This was the talk long before it actually happened. People are buying in, anticipating. You see, if you had bought on any one of these lows, you would have made money. And then, boom, the news comes out. Canada passes recreational marijuana, it's legal. And what happens? Boom, everyone sells off. The news is out. There's no more anticipation. So what happens is those who got in on the market and have been making good money are selling on the news to take their profits. This is nothing more than massive amounts of profit taking that pushes prices down. Now, looking at the indicators right now, it still looks like the momentum could go a lot lower, and there's a gap down here. And I'm sure there's someone in the audience here today that has this particular stock, but it might drop all the way down to fill this gap down here. You know, 25, 26, whatever that, 27 in this area. If it drops down, looking at a stock like you would look at any stock, If the gap fills and the technical signals start shifting another way, those are the kinds of stocks that create buying opportunities. So keep an eye on the technical charts, and you will all do fine. As long as you're managing risk, you're going to do absolutely fine. Now, there's a question that comes from Jeffrey, and where is the VIX going? I have 36 and 30 puts. Okay. Now, Jerry, remember what I just said on the VIX? The indicator right now is looking like it could go higher. And let me just tell you one thing. You bought the front month options. And although it's too late to do anything about it now because you bought it, I never, ever recommend people buying the front month options. Just because they're cheap doesn't mean that's the good bargain. Good thing that you bought in the money because there's less time value associated with that. But I think the VIX could still rally. And then once you get up into this area up here of resistance, and I think you could see another downturn. So for the short term, unfortunately, I think that those puts are probably going to go down in value. Not a guarantee, of course. It's just what the technicals are saying. And so what I would do, if you have any kind of a profit in them already, or if you could even get a break even, I would wait until you see the stochastics oscillator, the K line here. I would wait until that starts turning down again before you start buying puts. The stochastics is a really good leading indicator when you're looking at the K line, all right? And so that is a really good one to use, especially all option traders. When I was in Chicago, I presented right before the lunch hour on Friday, and I was talking about the stochastics. It's a great tool, not just for the equity traders, but also for the option traders as well. All right, now here we go. It's time for you to start typing in your stock symbols, and then what I'm going to do is I'm going to analyze them in rapid fire stock analysis format. So start typing those in. Ron, boy, you are fast. Holy mackerel, you are fast. Ron's first one on the board. Now, if I could just add one thing, like Ron, I don't know if any of you can see what he typed in there. He's asking for CROX. Ron added a comment, would this be a good entry point? If you could, give me a clue. Don't just put a stock symbol in there. Give me a clue as to what you think you're going to do with the stock. Do you have it already? Are you thinking about an entry point? Are you thinking about selling it? Are you thinking about doing an option on it? Let me know, because if I know what your intentions are, I can help you better off, at least with managing risk. All right, so let's look at CROX and take a look. CROX and put in enter. All right, immediately I see that the stock is down below its 20-period moving average, okay? So right there it's telling me that there is momentum going down. At least today we had a green candle, but the overall volume is telling me that it's going down, okay? So you have to watch this one, Ron, because if this stochastic crosses down and looks up, let me zoom in a little bit. If the stochastic starts to cross below the red line or the D line there, that could very well trigger some selling activity. All right, that's number one. Number two, you have to watch out for the former trend line. Let me show you what I'm talking about here. Let me see how far back I could go here. Let me back up a little bit. All right. Now, all right, so there's still a trend line that's intact, okay? So I'm going to take this low, and for those of you that have never drawn a trend line in your life, let me show you how you use what I call artistic license to free draw a trend line. Let me just move this chart out of the way and see if, okay, I can even go back as far back here. I'm just going to try to connect as many of these lows as I can. You see, and I'm going to extend out. You see that? Now, isn't that interesting? This low down here was the lowest of the low for the year. I connected out here, and I connected to here, here, and here. Now look at that carefully before I erase it. I'm going to erase it and do something else with it. Okay, see how I did that? Now I'm going to erase it, and I'm going to draw what the what engineers would do. Okay, hold on. Let me undo this. Clear drawing set. An engineer, and you have to understand, my college degree is in aerospace engineering, so I'm speaking from experience. An engineer has to be exact to the penny. So an engineer would take that little very, very low and start that line there, and then they would draw it to this line and extend out, and then lo and behold, if you did that, you'd say, oh, wait a minute, it's already broken down below the trend line. And you could say that that is true, all right? But that would be a past, that actually, then you would try to connect here and then maybe even go here. You could do that. But what happens is, you don't have to be exact on the money, to the penny. What I do is I try to capture as many of those lows as possible to give me a current trend line that is still acting as support. So let's do that over again. I'm just going to connect some of these lows here, and I'm trying to connect this one and this one, see, and this one and this one. So this one looks to me to be the best trend line that I can draw based on the data that I've collected here, okay? Now, what does that mean, drawing it this way? Well, if Ron is thinking about buying this stock, you certainly want to know where the most recent support level is. Now, a trend line, if it's still intact like the way I drew it, this trend line is still intact and will act as support, okay? So, Ron, my point is, if this stock all of a sudden starts breaking down below that trend line for whatever reason, abandon the idea totally of wanting to buy it. Just put it on your watch list and look at it another day. That's what you do if that starts to break, if the trend line starts to break. Now that I have the trend line, let me zoom in a little bit to show you what I would do. I would say if the stock goes down, I'm going to give it room to breathe. If the stock comes down here and then all of a sudden bounces off of there, then this area right here becomes my new entry point. I'm not trying to catch it as it's going to support, because if I'm trying to catch the falling knife and I buy it and then all of a sudden it breaks down below support, it might actually gap down. If it breaks below that long-term trend line, which is that's a trend line that's good for about a year now, it could very well gap down that 17.5, 17 or worse. So you have to really be patient when you see a stock like this. That's entry point number one right here, okay? The second entry point would be a closing price over the 20-period moving average. See, on this day, it went over the 20-period moving average, but didn't close over it, right? Why do I say above, a close? Well, if in the last 30 minutes tomorrow, let's say tomorrow, the low is here, and then it looks like it's going to close right above the moving average, and there's 30 minutes to go in tomorrow's trading session, Ron, that would be the time that you would buy it, because a closing price over the 20-period moving average would most likely continue the rally over the moving average. You follow? So if you get a closing price tomorrow or on Wednesday or Thursday or Friday over that moving average, what you would do is buy it, and then you put your stop below the trend line. Put it somewhere down here around 18 or 18 and a quarter. All right. Now that might be a $2 risk per share, but use that in your calculation using the 1% rule. Use that in your calculation. I would much rather give the stock more room to breathe than to try to buy it and put a stop like pennies below it, because you'll probably get stopped out and just suffer some frustration. So there's two entry points. Number one, I'll review. Two entry points: a bounce off of the trend line with a stop below the trend line, or a closing price over the 20-period moving average with the stop below the trend line. All right. I took a lot of time on that one, Ron. Hope you appreciate that. I'm going to move on to Philip. Philip says he doesn't have a position in Starbucks, Oh, I typed in the wrong symbol. SBUX. He doesn't have a position Starbucks. It's currently trading around 59. Actually, that's correct. It's 58.90 is the close. He's thinking of selling cash-covered puts on Starbucks. Now, I imagine you're talking about cash secured puts, right? I hope so, because I want to be clear on this, because a covered put is shorting the stock, okay? And shorting the stock and shorting the put. All right, so that would be a covered put. If you're thinking about selling the put as a cash secure put, that's bullish. A covered put is bearish. So if you could just clarify that for me, Philip, so I know that you are, just tell me if you're bullish or bearish on that strategy. Well, short term, while I'm waiting for you, short term, I'm going to tell you that the odds are stacked on the sell side that the price is going to start to move down. All right, it could very well move down. And I'll try to put these together as quickly as I can. Back here is an area where the gap filled back here. You see this? The gap filled here, and then the price reversed. That's usually what happens. 80% of the time a gap will fill. 80% of the time after the gap fills, it reverses. And there you go. Both cases were met. Both rules were met. Now, if I extend that out, because this is now resistance up here, if I extend that out, you'll see that the stock is still very close to a resistance area. It was resistance here, 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 here within pennies. And it looks to me like the stock is butting its head up against resistance. That's number one. That's a negative. That's bearish. Number two, the price has been going up with these green candles, but look at the volume. The volume has been dropping. That's bearish. All right, so that's bearish point number two. Number three, you'll see there's a wide divergence above that moving average. You can see that there's a history. The stock does not like to stay that far above that moving average. Whenever it's gone that far above it, it's snapped back to it. That's point number three, bearish. Now, finally, point four is the most bearish. It's already gone from being overbought and is now starting to move back down. So chances are the momentum is going to push the stochastics down lower, which, again, is bearish. So be really careful. I wouldn't think about taking a long position in that. And that would mean, I see a note there, cash secure put. That would be a long position. So with all that said, where would there be a good entry point for this one to put in a cash secure put? Well, I really like this area right here because this is a role reversal support level. You see? So there is a chance that Starbucks could drop down. And if you see any kind of a bounce in this area, after the stochastic has gone oversold and then pivoted up, that's when I would start selling cash secure puts. And at that point, I don't know what the November puts would be going for, but I don't think the $50 puts would be a good strike price. I don't think you get a whole lot of. I don't think you're going to get a whole lot of premium for that if you sold the $50 strike price. Because if you look at the November strikes, even now, what's going on? Here it is. November 50 puts are only trading for like 10 cents. Unless you typed in the wrong strike price, I would wait for the stock to pull back, and then I would consider selling the 55 puts only after the stochastic starts going back up. All right, let's go. Let's go to Netflix. Vitakuro, last name Vitakuro, thank you very much. I appreciate that. And let's look at NFLX. This is a hot one, Netflix. They have so much going on, and Netflix is actually becoming, cable TV's biggest enemy, biggest adversary. So let's look at the candles. Stochastics is crossed with sell signal today. We have a long stretch of red These are mixed signals, so I'm gonna label these off. You notice these are my previous lines. Last time I looked at Netflix, so I'm gonna erase all these. And it was pretty accurate if you look at it. You see how his stock did pull back from that resistance point. But let's do this again. Resistance is at a gap fill point. Boom, right there. Okay, this is resistance up here, and you have support that is tested 3 or 4 times here. All right. So we're looking at a trading channel. This is the bottom of the channel. It's support, upper resistance. It's the top of the channel. While the stochastics is pointing lower, the candles up above are giving us more bullish signals than bearish. This is a hammer pattern. 80% of the time after you see a hammer pattern, it goes up. Now, does that mean that the hammer pattern negates the stochastics? I would say that the hammer pattern overrides the stochastics, because if it does rally, and that is a pretty bullish sign. If you look back at Starbucks, you'll see that whenever we had long shadows, see, here's a hammer back here, here's a hammer back here. You see that? Whenever we had hammer patterns, the stock rallied. Here's one even up here. It's hard to see, but there's a hammer up here. Here's another hammer here. And let me zoom in so you can see what I'm talking about. Here's a hammer right there. See it? Little body candle with a long shadow underneath it. This is bullish. So remember, you just typed in a stock symbol, so I don't know what your intentions are, but if you're an option trader, you might consider selling a credit put spread, which is bullish. You might consider buying a long leap to leg into a calendar spread. That would be bullish. If you have enough money in your account and you want to buy the stock, you can consider buying the stock at $329 a share. But my forecast on this, I have to get the right angle here, and I'll show you what I'm doing. Okay, right there. All right. So here's a bullish candle. After a series of red candles, this is known as a stale red light. 4 red candles in a row mean we're long overdue for a green one. Look, 1, 2, 3, 4 back here. See, we have a stretch of 4 candles. Then we had a big green one. You see? Here we had 3 red candles, green one. 3 red candles, green one. 4 red candles, green one. You see? So we're probably going to rally. I'll even be so bold and say we'll probably rally tomorrow on Netflix. Now, with that said, if the stock rallies, the stochastics will start to turn sideways or maybe even go up at this point. You see? So I would say the signals are leaning more towards the buy side than the sell side. The volume is kind of just stabilized. It's not dropping by any stretch, but it's lower than what it was at the beginning of the red candle here. All right. So the other thing is this gap filled on Thursday. All right. So most likely, remember the rule, after a gap fills, the stock generally reverses 80% of the time. So again, that's leaning or telling us that there's more chance of a rally. Now, again, if you just popped on this call because you wanted to see what it's all about and you're not even asking a question or submitting a stock symbol, here's a good candidate, especially for the option traders. This is a really good candidate. And so if you decide to take a long position, let me address the most important part of this equation. If you take a long position for whatever reason and whatever strategy, it's a long position. As soon as the stock starts closing below this support line, which is a breakout to the downside for this trading channel, you cannot ignore that. In other words, if this stock starts doing this, you have to get out of the long position. Because if you don't, your long position is going to suffer. And because this is the kind of stock that could drop $100 easily. And there's still an open gap below the market. You see this? There's still an open gap, $100 below the market. Actually, it's just about $100 below the market. So Netflix could do that. That's why this line is so important right here. You see that? That is a critical support level for Netflix. So if you're going to trade it, do not ignore that support level. All right, thank you for that. Stuart is looking at GDXJ. and he's looking to buy it. So GDXJ, let me type in the right symbol there. Now, Stuart, it's interesting that you bring up this stock because I was looking at IAU, which is a lesser version of GLD. And you'll notice that the pattern is very similar. Let me erase all these lines here to clear it up. The gold market still has open gaps below the market. You see this? So, I was thinking about buying more silver today, but I looked at the gold market because a lot of times they work in tandem, all right? And I have a very hard time taking any new long positions in the precious metals until these gaps are filled. You'll notice the same thing is in GLD, which is the ETF for the gold market, you see? So there's a gap below the market here. Now, let's go back to your stock, and you can see that the pattern is very similar. What happened there? GDXJ. Did I type it in wrong? Let's see. What's going on here? GDXJ. There it is. Okay, sorry about that. Oh, there is a gap down there. I didn't see that because the 20-period moving average is over it. All right, so there's a good chance that this gap is going to fill before it rallies. All right, so I think that kind of cuts the chase here with your idea of buying. The other thing is, again, weighing the evidence, right? We're looking at all the data. The gap below the market will act as a price magnet to draw the stock down. You could see that the stretch from that moving average was quite wide last week and starting to pull back to the moving average. You can see that today, because it's a red candle, it has caused the K line to cross the D line. I'll zoom in just a little bit more so you can see. Actually, it's right on it. It's right on it. So that's good enough. Them touching is going to trigger a sell signal for the short-term traders. So I would wait for this one to pull back, and it might bounce off of the 20-period moving average. It might bounce off of the gap fill point. It might bounce off of this role reversal support level, pretty much in the same area. But from 27.5 to about 28.30 is all an area that I would consider to be buying in this area here. Right, because the gold markets, I'm really, really surprised that the gold markets haven't rallied and silver hasn't rallied as interest rates started to get higher there last week. Because historically, when I was trading gold and silver on the commodity exchange, when interest rates went up, gold and silver went up. It was a direct correlation, because the whole idea is the Fed would raise rates when they thought inflation was a threat. Well, for years and years, gold and silver and the precious metals have been a hedge against inflation. So right now, it's kind of screwy to see prices so low. I think the gold and silver markets are at low levels as it is. If I back this up and look at a weekly chart, again, Stuart, I'm taking probably a little bit more time than I normally do, but if you look at the weekly chart, you'll see that it's very, very close to these support levels from back here. And if I go straight across, you can see that we are right at a key support level for this one. So I wouldn't be afraid to buy it, but I would say, waiting a couple of days would probably suit you better as the stock pulls back and at least forms a nice pattern, all right? So if you do buy it, put your stop somewhere below support. If you want to put your stop and give it more room, put a $2 risk per share on that one and get out below the support level, all right? Hopefully that helped you out. We still have plenty of time left. Ruben, tell me, what are you thinking about with this stock? You're looking at FNKO. What's your interest? You own it already? You think about buying it? Because as I look at the chart, it's looking pretty bullish, actually, but I just want to make sure. I know there's a little bit of a delay, so if you could, Ruben, if you could put in what your intentions are, I'll try to pick that up from you, all right? All right, so let's look at this. You want to sell it to the next rally. Is that what you said? Okay, to sell the next rally. All right, well, I wouldn't sell it yet. And that comment is coming from the charts, not me. Remember, if you have an opinion, you're doing it wrong. If you're reading the charts, you're doing it right. Now, look back at this stock, and you'll see that the last time it broke out over the 20-period moving average was back here when it was trading for around $8. You see that? And then this stock, from this time back here, which is back in April of this year, this stock has not dropped below that 20-period, hasn't closed, I should say, hasn't closed below the 20-period moving average. It closed below the 20-period moving average back here in September, and it came very, very close here, very close. Zoom in a little bit more. It came very close to closing over the moving average here. But guess what? On this day, it closed exactly on the 20-period moving average. You see that? In fact, it closed at 2369. See, look at the bars up here, and I'll put my cursor on that day. It closed at 2369, and on that day, the moving average was 2369. So it did not cross above the moving average. All right? After it had gone below it, it didn't cross over it. However, today it did. You see that? Today it crossed over the moving average. That's significant, right? So if you own it, I wouldn't be selling this one just yet, because although it's hard to read this, the volume bar today is increasing. So it's a slight increase, but the volume picked up today as the stock closed over the 20-period moving average. And you see the stochastic, look what happened. It quickly reversed and started going back up again. So here's what I would do. If you're thinking about selling into a rally, I would at least wait for the stock to reach an overbought condition on the stochastics. That's number one. Number two, if you're looking at stochastics, you also want to pay close attention to the next resistance level. You see this? If it gets up here, and that's the angle that I'm taking from the rally back here. See the same, see how I draw the angle? That's how I'm drawing the angle here. I'm just basically mirroring the same angle from back here. All right. So this one could very well rally. And if it does continue up, you want to monitor the volume. If it's approaching resistance and then the volume starts to drop, that might be your time to get out. All righty. So hopefully that's going to help you. Okay. Now the next question, planning for Netflix put options on November 23rd. Okay. Again, I was talking about buying the front month options. I don't like buying the front month options because they're low to a time value, and time decay usually works against you when you're buying front month options. So be really careful about that. Okay. Herschel, welcome back. Herschel says LMT. Is that Lockheed Martin? I think it is. LMT. Yeah, Lockheed Martin. All right. Thinking to buy at this level. I would say no. And again, the charts are telling me to tell you that. Listen, let me erase all these lines so you could see and understand why. Here's the test question. Let me zoom in. And who wants to be the first one to answer? What pattern is this today? What's this two-day pattern called? Can anyone tell me? Who wants to be the first one? Let's see. We got a lot of people on the call today. All right, good. All right, I know there's a delay. Let's see who wants to be the first one. The two-day pattern, the most recent pattern, this big red candle is doing what to the red candle? It's, all right, there's too big of a delay. That's a bearish engulfing pattern, all right? So, Herschel, a bearish engulfing pattern is not something that you should ignore, because if you look at the other bearish engulfing patterns here, there's one right there, stock dropped. Back here was a bearish engulfing pattern, stock dropped. Back here was a bearish engulfing pattern, small one, but still a bearish engulfing pattern, stock dropped. Here was a bearish engulfing pattern that came right before this bearish engulfing pattern. Obviously, the stock went lower. If you look back and were to count all the bearish engulfing patterns, like here, stock dropped. Here, stock dropped. On almost every bearish engulfing pattern, even back here, the stock dropped. So here we are faced with another bearish engulfing pattern, and guess what? The volume is increasing, and the stochastics is increasing the momentum to the downside. So what I would say is draw a horizontal line on the chart that represents a good role reversal or support level. I'm going to draw it right from here, which is a gap fill support level. And then what you do is right around like 320, put a price alert on this one. Now, on this particular platform, all I have to do is create an alert, and I'm going to put price alert 321, create. So when the stock starts getting down to a support level here, my alert will notify me that the stock is there so that I don't have to look at it every day. And then what you do is you kind of reevaluate all the signs that are coming from the charts at that particular point. So in other words, if the alert goes off and it's near a support level, you want to see, is volume increasing or decreasing? Well, if the stock is pulling back to support and the volume is now decreasing, that's bullish because it's telling us the sellers are slowing down. If the stock goes down to support and all of a sudden the stochastics are starting to go up, is that bullish or bearish? That would be bullish, right? Do I see a hammer pattern? Do I see a bullish engulfing pattern? Do I see a doji? Those will all be bullish signs. So right now, the charts are basically telling you to hold off and wait, all right? Plus, Herschel, remember, we looked at the Dow, right? We looked at the Dow, and the Dow still has a bearish engulfing pattern with some room to the downside. So that's, again, another reason why we should watch the general markets, because LMT trades, you know, in the Dow, in the market, in the listed stocks. So chances are, if the Dow drops, LMT is going to drop because it's a higher price stock. The other thing is you might want to consider maybe a conservative option strategy if you feel comfortable with that. All right, Kevin, why are the regional banks tanking? They don't usually rally on rising rates. Well, interestingly enough, let's look at BOA. All right, well, that's not regional bank. That's Bank of America. Where is it? BOA. Yeah, that's Boeing. That's Bank of America. I can't remember the symbol. Anyway, what's happening with the banks is it's not like there's one particular news item that's out, but what's happening is there's a lot of analysts out there that are starting to readjust their price targets. And interestingly enough, that if you look at what's the MS, let's look at Morgan Stanley, for instance. You see, like stocks like Morgan Stanley, you look at Schwab, you know, you got a lot of downward trading channels. So a lot of this is technical. And what's happening is with the rising rates, you would think, oh, people are going to just start putting money into the banks to get interest rates. Well, the interest rates aren't high enough to really have people get excited about, you know, a money market fund at this particular point. You got Morgan Stanley is also showing a bearish engulfing pattern, and the technicals are still pointing lower. Excuse me. So I would just, I'm not saying ignore the news. I would certainly ignore analyst forecasts and price targets, and pay more attention to the technicals, because you're going to see that there is long-term trends are starting to shift. And you can see, like Morgan Stanley, this is a significant downward trend that we're seeing since really the January, February, March in this area up here. Okay, this is a weekly chart, right? So again, trade technically and make sure you have your stops put in place. All right, so Ruben has another one about how about SQ? Is that Square? Is that the company Square? Yeah, Square Inc. All right. So you're trying to sell this one as well. All right. Now, this is a monthly chart, a weekly chart rather. You see this? The weekly chart is showing stochastics still going lower, but let me shrink my box. You can't see I have a box in front of me. It's a control panel that gets in the way. You can't see this, but this particular stock has been a significant upward trend, and it very, very rarely goes below 20. And that's because it's in an upward trend. You'll see it'll many more times be overbought than it is oversold. And back here from April to July, it stayed oversold for a while as the stock was just kind of consolidating sideways. So this is the weekly chart. Now on the weekly chart, the volume is dropping. Now I can't really count today because today's only one day in the trading week. So of course that's going to be low. But last week's volume dropped pretty dramatically. You see, that's almost a 50% drop in volume. Now, while we're staying on the weekly chart, you'll notice this is almost a gap up here. It's not quite a gap, but it's very close to a gap. If we now switch to the daily chart, okay, you'll see that this is now shifting higher. So I wouldn't be too quick to sell this one because the signals are shifting to the upside. Okay, let me get rid of these so you can see. There's a hammer pattern there. Can you see the hammer pattern? We'll zoom in a little bit more. That's a hammer pattern. That's bullish. The green body falls within the red body. This is as bullish as a bullish engulfing pattern. That's very close to a Harami right there. That's bullish. The stochastics is going up, and the green candle, being green positive, is on slightly higher volume. There's a wide divergence from the 20-period moving average, so there is more buy signals than sell signals. Now, with that said, if you're thinking about selling it, I would look to sell if it starts pulling back from the 20-period moving average. So this stock actually could rally about $10 before the sellers start coming back into it. So it looks a lot more bullish than bearish, and hopefully that helped you out. Now I'm gonna have to cut it off of there because we're already over by a minute. Thank you so much. I really appreciate everyone's participating in this. And I had to race back for a moment. I thought I was going to have to broadcast from my truck. Today was the first day of lacrosse practice for the fall season. So I was out there on the field with the kids today, and I raced back to quick get the computer on and get things going. So we made it. And for the members who subscribe to our trade alert services, this will be recorded, or it is recorded, and the recording will be posted on the member page, all right? If you're not a member, you might want to consider being a member. It's a really great service that we offer, pretty inexpensive for the trade candidates that we put out. And you're learning as you trade. You know, it's like a trade alert built into a lesson plan with all the signals attached and describing the signals. So hopefully you're getting a lot out of this. And I really appreciate you sticking with us. So have a good rest of the week. Keep your eye on the markets, especially the weekly market report, and we'll have to see what happens right up until midterm elections. So have a good evening, everyone. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.